Hello and welcome to this introduction to credit derivatives brought to you by Passing Score, where you can get more help on your exam prep at PassingScoreFinance.com. In this video, we'll be going over the definition and basic structure of credit derivatives, a quick example, and then some of the risks that are involved. First, let's start with what is a credit derivative. It's an instrument that allows you to separate the credit or default risk from an asset or pool of debt instruments and trade them to another party. Now we're just separating the credit or default risk. None of the other features of the bond are part of the credit derivative. These can then be bought and sold between private parties or through the open market. Now, why would you want to do something like this? Well, for hedging purposes, if you're managing a portfolio that involves credit risk, you might want to actively manage the credit exposure in your positions. And you can increase or decrease the credit risk by using credit derivatives. You can also speculate on future credit events using credit derivatives. If you have a strong view on the movement of the overall credit markets, a specific industry, or even a specific issuer, you can profit from that view using a credit derivative. And there are also certain arbitrage positions that have involved credit derivatives as well. Now, what kind of assets are we talking about? These can be bank loans, corporate debts, trade receivables, or foreign government debt, otherwise known as sovereign debt. Any of these are known as reference obligations or underlying assets. These are two terms that you'll see often involving derivatives. These are what cause the movement of the value of the derivatives. It's the basis for their value. Again, those are reference obligations or underlying assets of the derivative. Now, here's the basic structure of a credit derivative. We have a protection buyer who may or may not be holding the bond or reference obligation involved. But in any case, they want to sell the credit risk of that, and they're willing to pay a certain premium to the protection seller, who accepts that money or the premium but also accepts the credit risks along with those as well. Now, in the other direction, if there's a credit event, the protection seller has to pay off the default payment to the protection buyer. This is why it's very similar to insurance. The protection buyer pays a premium, and the protection seller may or may not have to pay off in the event of a credit event. But they are taking the risk, which is certainly worth the value of those premiums. Now, here's a listing of different kinds of credit events. They can be a bankruptcy, a debt restructuring, or even a lowered credit rating that could trigger the default payment. Let's look at an example with some numbers so you have a better idea. We have the protection buyer who's willing to pay this premium of 28 basis points per year to the protection seller, and they'll pay that every 6 months in these semi-annual payments. In exchange for taking that risk, the protection seller offers to make a default payment in the event of a credit event. In our example here, this is a 1-year term for a $10 million worth of the reference obligation. Our credit event is a restructuring or failure to pay by the issuer of that reference obligation. And let's say that credit event has occurred and the bond price falls to 83. The protection seller now has to pay back the default payment, and that is this formula of the principal, the $10 million, times the difference in the par value versus the recovery, what they can get for that bond after this credit event. In this case, the price is 83 and they have to pay $1.7 million. And this can be a pure cash settlement. They just pay that amount to the person wanting this credit insurance, or they can accept the bond and pay off the full par amount of $10 million and then try to sell this bond for as much as they can. They might even negotiate with the issuer to get a higher recovery value on the bond. And of course, there's the annual premium, which we said was 28 basis points. So that'll work out to $28,000 based on a $10 million underlying amount. Now, there's a lot of risks involved besides just the pure default risk. With any kind of derivative of this kind, we have a counterparty risk. You're making an agreement with someone else to pay you or making the steady premium payments or the default payments, and they may or may not be willing or able to hold up their end of the bargain when it comes time to pay. And that's the counterparty risk. The liquidity risk is definitely an issue for our credit derivative because if they're not able to sell their bond on either side of the contract, that's a significant problem for our credit derivative parties. We have an operational risk, just the documentation, all of the paperwork, the internal controls, and how we settle the credit derivative. And then we also have a basis risk that can occur if the credit derivative underlying or reference obligation is not the exact amount that we have that we're hedging against. So if we have a pool of credit positions and we buy a credit derivative that for our credit positions are not exactly the same, they can move in different directions so that you don't have a perfect hedge between the two items. And that's our basis risk, the difference between the value of the derivative and what you're trying to hedge. Now, there's many types of credit derivatives. There's credit default swaps, synthetic CDOs, and some of these get a little bit complex, and we'll be covering some of these in future lessons. Well, that's it for our introduction to credit derivatives. If you have any questions, please feel free to email me at john@passingscorefinance.com, and thank you for listening.